Right now, as you're watching this video, there are, I would say, at least 1 million traders out there looking at a chart on TradingView, and 95%, probably 98% of them are totally convinced that these lines on a chart, these indicators, these patterns, they hold the secret to trading profitably. They're analyzing all the patterns, drawing endless trend lines, adding dozens of indicators, trying to find the perfect combo, trying to find the system, the framework that works on the chart, that gives them the consistency they're looking for. And to do that, often, what they do? They spend thousands on expensive courses that try to teach them how to look at a chart, how to trade a chart. But what if the way almost everyone is taught to look at those charts is just a massive multi-million-dollar lie? Okay, I want to answer that question for you today. We're taking apart that exact illusion, and it's an illusion. You're going to see why it is in a minute. I'm going to show you exactly why the charts can lie to you. I'm going to reveal the real engine that actually moves the market. Okay, let's unpack this. We have to start with the illusion itself. What is the massive lie that everyone, 98% of traders, fall for? Well, the big lie is simply that all you need is the chart. Why? Because, the people that sell the courses want to keep things the way they can explain, and they don't understand things outside of the technical chart. So they tell you, well, all you need is the chart. Buy this mentorship, buy this program. I'm going to show you that all you need is the chart. I'm going to show you the exact model that works. Well, so you have a massive industry of Instagram gurus and, mentorship sellers, and they've built a whole ecosystem around teaching retail traders just to stare and look at a chart, because that's what they can sell easily. That's what retail traders can understand, and so they jump into that. And they look to dissect all the possible elements on the chart, and what happens? They look for shapes, they look for clues, and they use incredibly complex sounding names just to make it look, professional. But believe it or not, it's just all repurposed stuff. It's always the same stuff over and over again, just repackaged into different names to sell you, the next mentorship or whatever. Whether it's just smart money concepts, supply and demand, anything you can think of is just the same stuff with different names, just repurposed with different names. Someone may call it demand zone, someone may call it support, someone's going to call this a double bottom, someone's going to call this a supply zone, someone else is going to call it an order block. It's all the same stuff, okay? And this is where we start to draw a line in this video. I'm not here to tell you that technical analysis is useless. I'm not here to tell you that, because it's not. I use technical analysis, okay? I don't trade without a technical trigger, which, if you look in this video so far, it's going to sound a little counterintuitive, but you'll see what I mean in a minute. So I want to make this as clear as possible. I'm not here to tell you that technicals are useless, not at all. But what I'm here to tell you is that technical analysis can be an illusion. It can fool you in looking for a pattern where there's none. An expensive, time-consuming, also annoying illusion, okay? Why? Because the reality is that the charts are not the cause for anything. The charts are merely the result. So now you're going to be thinking, okay, if the chart does not cause the price to move, well, what does? To understand that, we have to go beyond the charts, away from the charts. And to do that, I want you to understand the core concepts that I need you to anchor for the rest of this video, which is going to fundamentally change the way you look at your trading. Right now, as I said, the trading education space is a mess. You got mentorship sellers pointing to historical charts, circling specific candlesticks, and they're gonna say, look, price reversed here, so it was because of this candle. Look, price reversed here because of this candle, because of this double top. Which, if you think about it, is crazy. It's an incredibly dangerous confusion of correlation and causation, because the candle did not change anything. The candle didn't cause the move itself. The candle is the ink on the recipe. It's a footprint. It's the visual record of an action that has already taken place. So it's the footprint of whatever has already happened. In other words, the chart is the visual record of funds that have already moved. Now, it's useful, it's insightful, it's a footprint, so it can be useful, as I said. But it's not the reason why funds decide, to sell the euro against the dollar in this case, or to buy it back in this case. It's not because of this double bottom or this double top. See, the truth is that price moves because it's forced to reposition. Market participants, the big ones, they don't move their funds because a candlestick on a chart formed a certain shape. They move because of shifts in interest rate expectations. They move because of shifts in geopolitics, which create a different kind of interest rate expectation. So they move because something is changing behind the chart. They move because of real-world events that force them to adjust their positions, to adjust their portfolios, to adjust their allocations, and whatever. That fundamental macroeconomic shift is the true engine behind the market. This is the reason why the euro sold against the dollar in this case, and this is the reason why the euro bounced back against the dollar in this case. Now, I'm saying this in hindsight because, as the technical trader that says, oh, this is why the euro USD topped because of this double bottom. Well, I'm saying in hindsight, this is why the dollar strengthened because of this NFP number. Okay, fair enough, but keep watching and I'm going to explain you where this is going. So let's see in practice how a retail trader actually fails for the illusion of technical analysis, okay? Because this happens all the time. Now, imagine a retail trader opens up their screen and they're looking at the S&P 500 and they're seeing a classic technical setup, a head and shoulder setup. Now we got the left shoulder right here, we got the head here, and you got the right shoulder right here. And the neckline, to some extent, I would say is this. Okay, anyone who's ever taken a basic trading program, watched a quick video on YouTube about technical analysis, know very well what an head and shoulder is. And you understand it's a bearish pattern. This should say that this should continue lower. Plus, if you also zoom in a little, we see that we're looking at a bearish trend, lower lows, lower highs. This is a bearish trend. This should continue lower. Now, technical analysis says it very basically. It's a bearish trend. We got a bearish head and shoulder on the chart as well. Now, a retail trader can easily see this and say, I want to be short because this is bearish. Okay, now what does a real trader do? What does a professional trader do? Well, he's obviously seeing the head and shoulder. It's basic stuff. And he's seeing the bearish trend as well. But he goes beyond the chart. And beyond the chart, what do we see? The macro context. In this particular case, Trump has just announced that he's as close as ever. Now, okay, I understand he said it 40 times, but in this case, it was as close as ever to reaching a deal with Iran. And he actually called off an escalation that he threatened. And it's actually the reason why this went down this much, because he was looking to escalate the geopolitical context again. But at some point he said, hey, things are changing, his negotiation tactics play out like that. But anyway, he went on and called off the escalation and said, hey, we're about to make a deal. Now, if you are an institutional investor managing a decent fund, the kind of fund, that kind of moves the needle in the market, what do you do here? Do you short because, hey, it's an head and shoulder pattern, so I want to go short? Do you short because, hey, it's a bearish trend, so I want to go short? Or instead, do you long because the macro context just pivoted into a more positive risk context with the deal with Iran, which is about to open up a sort of a mood, reducing inflation risk, reducing rate hike risks, reducing geopolitical tensions in general? Well, if you think about it, the answer is pretty obvious, okay? Understand where I'm going here? Now, how does one headline like this actually feed into moves on a chart, okay? How is this bullish for the S&P 500, for instance? I want to trace the causality here, okay? How does a headline lead to actually a market move? Well, there is a golden rule for understanding fundamentals. It goes like this. Narratives move expectations, and expectations move the market. Understanding this specific chain reaction is the entire game. Okay, so the chain reaction starts with a macro development, the narrative. In this case, a de-escalation with Iran, which leads to the reopening of the Strait of Hormuz. Now, obviously, I don't need to tell you that the Middle East is a massive hub for global oil production, and Hormuz is a critical center for that. So the announcement of a potential deal, a de-escalatory comment from Trump, obviously instantly shapes expectations. Hormuz reopening, lower inflation risks, lower oil prices, less likelihood of interest rate hikes from the Federal Reserve. So in this macro context, in this macro development here, in this narrative right here, we've got the context figured out. We know the S&P 500 is in a favorable macro environment. It's in a favorable sentiment and likely to move higher because of this. Okay? Narrative shapes expectations. Expectations shapes the market movement. Okay. This right here is where we start to bring the technical charts back into the picture. And this is where the entire illusion starts to really become obvious and evident, because suddenly, by understanding that, hey, the macro context is actually positive for the S&P 500 right now, there's no reason to short. Instead, we should be looking for longs. Well, guess what happens? That head and shoulder that we saw earlier disappears, and it becomes this, a bullish setup, break of market structure, whatever you want to call it. See what just happened here? Now, a trader may see a bearish setup, a trader may see the head and shoulder, break of the neckline as well. Another trader may see a bullish setup, may see this break of market structure, against the trend, whatever. All of these different opinions on the chart. What makes the difference? What really makes the difference between a trader that sees a bearish setup and a trader that sees a bullish setup, and so on and so forth? Well, the macro context makes the difference. It's the macro context that tells us which setup on the chart is more important, is more reliable at this moment in time. And so we aren't just trading shapes anymore in this case. You see what I'm going? You're using the shape, the technical trigger, to execute a trade that is backed by the macro context, by the real engine that moves the market. The macro context is telling us, hey, this is likely to move higher. Ignore whatever bearish setup you're looking at. If there's a bearish head and shoulder, it's probably not going to work. This is a bearish trend. Okay, well, it's probably going to turn now because the context has changed. And that's exactly what we do, by the way. We went long the S&P 500 on the geopolitical news flow, anticipating what was going to unfold, which actually did. The memorandum deal with Iran was actually officially announced. So the S&P 500 jumped over the weekend and it started to push further higher. How that is actually likely to, at some point, hit new all-time highs. Now, all that said, by the way, I'm not here just talking with no recipes. You can see exactly how this approach performs consistently over time. There's no point in listening to someone talk about trading unless they show and prove that what they talk about actually works. Okay, so unlike 95% of trading influencers and channels out there that talk about trading without a verified track record, just to believe me, well, I do things differently. You can see the consistency of this approach, of putting a little bit of fundamentals in your trading. So all of this to say that technicals are not useless, but the chart, the technical analysis can be an illusion. The issue here is purely on the order of operation of the two. Amateur traders, retail traders treat technical analysis as the heavy, solid base of the strategy, the whole reason for their trading, when in reality, technical analysis should be the tip of the spear, essentially. You should use the macroeconomic environment, the central banks, the geopolitical narrative, the flows of capital, interest rates, monetary policy, all of that to carve the reason why a certain technical setup should work, why the market should move in a certain direction. That is what gives you a real strategy. Fundamentals for direction, okay? You understand that things should move in a certain direction fundamentally, and then you use technicals, for the entry. I repeat, fundamentals give you the trend and the flow of the direction to look for trades into, and it tells you, hey, if there's a bearish setup here after this macro development, if you see a bearish setup, it's probably not going to work, okay? Look only for bullish setups, because if you look closely on any chart, you can go on a chart right now, and if you look closely, you're going to find both a bullish and a bearish setup. Because I guarantee you, if you find a bullish setup, there's going to be a trader somewhere else, which is right now in this moment in time and looking at the same chart and seeing a bearish setup. So what makes the difference? The macro context, the fundamental narrative. If the macro backdrop dictates that there is a positive, for instance, in this case, positive geopolitical development that is leading to lower inflation risks, lower rate hike risks, and so on and so forth, which is bullish for an asset like the S&P 500, well, this chart, this bearish setup right here, becomes this chart, which is now a bullish setup. See the illusion? You can see whatever you want to see on the chart. Technical analysis is just a tool. It's a tool to allow you to execute in the direction in which you expect the market to follow, in which you expect the market to move into. Now, if this video opened up your eyes even just a little bit, that's a step in the right direction. Let me know with a like on the video down below.